Hello, everybody, and welcome to the Public Podcast. I'm your host, Kinsey Grant, here with you today to discuss the Fed's recent decision to hike interest rates by 25 basis points, to get info on all of that, how it's affecting the economy, the recession, what comes next. Big questions we're going to answer here today. Super excited to introduce you to our guest in just a second, but before we meet the guest, want to make sure you know, feel free to check us out on Spotify at The Public Podcast and on YouTube at Public Invest for in-depth interviews to help keep your portfolio on track. So with that, I'm thrilled to welcome our guest today. We have some big questions. I know we're going to get some big answers out of that as well. Joseph Wang, CIO at Monetary Macro. Joseph, welcome to Public. How are you?
I'm doing well. Thanks so much for inviting me. It's a pleasure to be here.
Of course. We're happy to have you. Like I said, some big questions happening for anybody who is a fan of following economic news, for anybody who's an investor, for anybody who wants to be informed about what's happening in our economy. The Fed decided to raise interest rates by 25 basis points, bringing its target rate between 5 and 5.25%. Before cutting rates, the Fed's primary goal, as we know, to ensure inflation gets back to its 2% targeted annual rate, to work on easing a pretty tight labor market. How the Fed has decided to do that has certainly been something that anybody who's listening to this podcast has been watching really, really closely. With that in mind, I'm curious, Joseph, what you took away from the recent Fed announcement about interest rates this week. Tell me a little bit more about what your take was.
Sure. So I think first of all, the Fed doesn't like to surprise markets. So as you noted, they hiked 25 basis points, but that was well telegraphed. I think the big change is that the Fed's statement changed. Last time in March, they indicated that they would continue to hike rates pretty strongly. This time around, they changed the language in their statements to suggest that, they might not necessarily hike rates anymore. So this rate hike could be the last in this cycle. What they're saying now is they're going to be hyper data dependent. Now, as you noted, Kinsey, over the past few weeks, we've gotten a lot of data, and inflation is still pretty high. The Fed's favorite measure of inflation is something called core PCE, and that's still showing, let's say, between 4 and 5% inflation, which is far above 2%. And as you noted, the economy still is okay. The unemployment rate is very low. Wages continue to grow at about 5%. So the Fed is looking at this and saying, I'm going to do 25 basis points and I'm just going to hold here for a while and to see how things go. They think that monetary policy acts on a lag. So they want to see all these aggressive rate hikes to see if it's actually working. Now, Chair Powell also noted a couple things that sways his decision in potentially pausing here, to be clear. Now, if inflation heats up, they're going to keep hiking. The first thing is that Chair Powell notes is that there are two other things acting in the background to slow the economy in addition to his rate hikes. The first is quantitative tightening. Now, as we all know, the Fed is shrinking its balance sheet. It's shrinking it at actually a pretty aggressive rate. This time around, the Fed's maximum quantitative tightening target is about $95 billion a month. The maximum we got to last time the Fed did this was $50 billion a month. So the Fed, just like they're aggressively hiked rates over the past few months, so they're also aggressively tightening their balance sheet. So that's going to slow the economy as well. Now, the other thing that Chair Powell noted is that we also have potentially some more stress in the banking sector. Now, banks are really important for the economy because banks create money. So if you go out and get a loan from a bank, the bank gives you money and then you can take that money and spend. So if you have a lot of bank lending, that's obviously positive for economic growth and inflation. Now, we're seeing some stress in some parts of the banking sector, and Chair Powell notes that and says that, hey, that's going to do a little bit of the slowing down for us as well. So all in all, he's saying we have a lot of things happening in the markets. We have the economy still pretty hot. Inflation is still pretty hot. The economy is moderating, but also a lot of tightening in the pipeline. So they're going to wait and see how that goes.
Yeah, this is a great way to start the conversation, I think, here, Joseph. Knowing that the Fed is heavily data dependent, we have a lot of important data that I do want to get to. Some of these points that you brought up, these measures and metrics that you brought up in that initial answer here. But before we get into that, I want to dig in a little deeper to the banking crisis that's happening right now. you mentioned that the Fed doesn't really like to surprise markets. I think the market was taken at least a little bit by surprise when this banking crisis kicked off. When SVB happened, it feels like a lifetime ago, but also yesterday. I think it was several weeks ago at this point. We've seen a lot of turbulence hit the banking sector right now. Regional bank stocks have tumbled. An example, PacWest fell more than 40% after Fed Chair Powell expressed, the optimism just that maybe this initial wave of bank failures has passed. But I'm curious to hear your thoughts on how the market might be perceiving what's happening in the banking sector right now as potentially, at odds with what the Fed is saying, or in I don't know, how are these two headlines kind of going together to drive market psychology or optimism or pessimism? Tell me a little bit more about how investors might be perceiving the fact that the banking sector is struggling, but the Fed is signaling maybe interest rates might be hitting the brakes in the immediate or near future. Tell me a little bit more about how we're perceiving all this.
Yeah, I think, Kinsey, your word perception is the key here. So, as we noted in Chair Powell's conference, he noted that the banking sector has broadly improved a lot since March. Now, something about the Fed, and I used to work there, is that they have super good data on what's happening in the banking sector. In fact, if you're a large bank, you actually have Fed staff sitting inside the bank watching what's happening. So, they get pretty timely data as to what's happening. And from his observation, things, I think, is accurate. Actually, things were improving. Now, as you noted, in March, we had basically a bank run. You had a lot of people who were depositors in Silicon Valley Bank suddenly take all their money out, causing a run, and then Silicon Valley Bank failed. A similar thing happened with First Republic. And that panicked a lot of the regional banks. But what we learned, though, from their earnings calls, which were over the past couple of weeks, is that one by one, they all disclosed that, yes, there was a panic in March. They had a lot of people pull money out, but thereafter, it stopped and deposits came back. So, from their perspective, what the data on the ground, what these regional banks were telling us was that things were slowing, things were stabilizing. And that's what the Fed sees in their data as well. But then, fast forward to this week, we suddenly see regional bank stock prices cratering. Now, of course, that's creating the perception of a tremendous bank run. Everyone in the market remembers this is what happened to Silicon Valley Bank. Their stocks tanked because there was a run. So maybe we're looking at Pacific West, maybe we're looking at Western Alliance or any other of these regional bank stocks. Maybe that means that they're also under severe stress because they're looking at price, and that's changing the narrative, changing the perception, as you rightly note. But here's the thing, though. All these banks, they came out with a statement saying, yeah, we haven't really seen any changes in our deposits. So Western Alliance, for example, today, well, actually last evening, came out with a statement saying that they haven't seen meaningful deposit outflow. So I think this is a situation where price is shaping the narrative rather than what's actually happening on the ground. Now, this is very dangerous because a lot of people who don't really spend too much time looking at banks can look at the stock price at a bank, see it's falling, think that something bad is happening, and panic and take money out. So what could be an otherwise okay situation could turn into actually a legitimate bank run if we have this kind of, I guess, poor sentiment due to price declines. Now, one thing I'll note is that there's some interesting reporting from one of the reporters at the Wall Street Journal that's been looking into these sudden price declines. Something interesting that he's noted is that there's a tremendous increase in put options on some of these names. Now, if you guys remember what happened during the meme stock craze in a couple years ago, you can buy a lot of call options, and that pushes upward pressure to the stock and makes it squeeze higher. Now, the same thing can happen in reverse if people buy a lot of put options. We also had today what appears to be a false story floated by a major publication about Western Alliance thinking about selling itself. So again, there's a lot of negative sentiment fueled by price action, a lot of nervousness. But so far, though, it doesn't seem like there's an actual run. But that could change rapidly if this poor sentiment actually continues. And that's going to be a big problem for the Fed because they're going to try to stabilize the regional banking panic because they obviously don't want to, they want this to continue.
So my question to follow up on all of that is how the Fed might balance being data driven, having the dual mandate that the Fed has, inflation and employment. How does it balance that with its responsibility to kind of be in a lot of ways, the arbiter of the way we're perceiving market news? How can we kind of square the emotional aspects with the data driven aspects?
Yeah, this is going to be a really tough job for the Fed because if this gets out of hand, you could easily come into a session where you quote unquote over tighten. So if you have a real legitimate panic, then you're not going to be worried about inflation anymore because the economy would do pretty poorly. Now the Fed has already taken out some big tools to try to combat this. Last month they rolled out this new bank term lending facility, but I think they still have tools up their sleeve. So right now, there's of course a panic in terms of the pricing in the market, a lot of prices coming down, but there are also a couple narratives that support this. One popular narrative is that the banks are having tremendous deposit flight because money market funds are yielding higher than bank deposits. Another popular narrative is that banks are insolvent because rate hikes made them insolvent by giving them lots of unrealized losses. So these two narratives, I can see how they can be convincing, but it's kind of doesn't really make too much sense to me. For example, if you're a bank facing a lot of withdrawals because of your interest rates are too low, you can just raise your interest rates a little bit. It'll hurt your profitability, but the next time the Fed cuts rates, which is maybe not too far from now, then you'll be back in the black. The same thing for the solvency thing, though, it's a little bit more complicated, and this is where the big guns I alluded to could come in. Now, during the great financial crises, one of the tools that the Fed and Treasury together used was to basically guarantee all deposits. That's something that could potentially be rolled out to calm markets if this panic doesn't subside. In fact, there's some reporting that suggests that they're thinking about this right now. For them, in my view, that's the next logical step.
And how likely is it that that happens?
Well, we got to see if these. I think it's actually pretty likely. So today, I'm looking at the prices in regional bank stocks. Again, they don't seem to be doing very well. If this continues tomorrow, I think it's in my personal view, it's a good bet to think that there's going to be some more policy measures to contain this, to change the perception, and the next logical step would be to have widespread deposit guarantees. So maybe this weekend or tomorrow.
Wow. Okay. Certainly something that we'll have to keep tabs on. And now that we've gotten the big picture of what's happening in the banking sector and potential banking crises, sort of what comes next with that, I would love to zoom in a little bit more specifically on what the Fed is doing, right? We've talked a little bit about the big picture contours of the strategy right now that the Fed is deploying, but knowing, to your earlier point, that they are very data driven, that they have incredible data at their disposal, let's talk about some of the metrics and measurements that might be driving the Fed's decision right now. I think the most important for many of the people who are listening to this today is probably getting the perspective on inflation. You mentioned that the Fed obviously has the great data around core PCE. We've also got the CPI index. Seeing a lot of higher prices, inflation has remained pretty sticky. I'm curious to hear your perspective on what kind of data you might be expecting the Fed to really take into account as it's moving forward and trying to decide whether another rate hike might be necessary or not.
Yeah, so Chair Powell has been pretty clear that he's laser focused on employment, specifically wage data. So we are a service driven economy. So a big part of a cost of anything that goes into inflation is wages. And right now, the Fed's favorite measure of wage growth is something called the Employment Cost Index. Now, that just came out last week, and it showed that wages are still growing between, let's say, 4 and 5%. In fact, it actually accelerated quarter over quarter. Now, if you have wages growing about 4 to 5% a year, then obviously inflation is going to be persistent. One way I like to think about this is, let's say prices are going higher. Why can they keep going higher? Because people can continue to afford higher prices. If you have prices going up at 5%, but your wages are also going up at 5%, then obviously prices could continue to go higher. And we actually have very good earnings data from companies showing that they're all raising prices because they kind of feel that they have market power, and that causes inflation to continue. So the Fed is laser focused on whether or not wage growth is going to continue. So far, it's been pretty persistent. And there's actually very strong fundamental reasons why that's the case. One of the big macro things that's happening right now is that we have a workforce population that's not growing in the same way that we used to. So let's say for the past few hundred years, people had large families or working age population was growing. But then a few decades ago, people decided to have smaller families. So as that gets worked through the pipeline, well, we have a shrinking workforce. That means that if the labor force is not growing in the same way that it used to, obviously unemployment will stay low, wages stay high. You can think of it as a shortage of workers, and this is something that's happening throughout the developed world, and even in countries like China, where because of their one-child policy, they have a very population that's shrinking very rapidly. So I think the Fed has its work cut out for them. They're trying to get employment, let's say unemployment a little bit higher, wage growth a little bit lower, but you have this tailwind of a shortage of employees. So going forward, we're going to have to watch specifically what happens tomorrow, non-farm payroll, to see if really the job growth, the labor market is still super hot. It's been cooling a little bit, but it's still historically pretty strong.
Yeah, it's such an interesting time to try to really wrap your brain around the labor market. It's certainly for a lot of people, I'm sure, who began an investing journey over the last several years, which I know there are many of them out there, myself included. This is a pretty peculiar labor market. You're looking at, unemployment is so low, the labor market's really tight, but you're also seeing all of these headlines about people who work in tech getting laid off really en masse, and how the labor market will respond to all of these different shocks to the system, I think is really interesting. And it's been a fun time to be a data nerd. I think it's probably an
Yeah,
interesting time for a lot of people to get into understanding unemployment data and employment data broadly speaking.
one of the most interesting things this time around is that layoffs are showing up in places that you wouldn't expect. So the common narrative is that the Fed hikes rates and interest rate sensitive industries like real estate, construction, they have lots of layoffs there. That's certainly what happened during the great financial crises. But this time the Fed is hiking rates, and the residential construction seems to be okay. If you look at the new home builders, they're at all-time highs. That's because there's continued to be lots of demand for new construction. But the segment of the economy that's actually being affected is another interest rate sensitive sector, and that's tech. So you have Fed hiking rates, but all these blue collar jobs that used to suffer because of the Fed are doing okay. But you have these white collar jobs, the big tech people, who is also obviously a very interest rate sensitive industry, uh, seeing layoffs. But those guys, there's reporting that suggests that they'll be fine. They find new jobs very quickly. So um, we don't have to cry for them too badly.
Definitely not. Yeah. All of the perks of being a tech worker. Certainly
Yeah.
it's been a bit of a reckoning in the startup and tech world for the last several months. So, okay. So Joseph, we've talked a lot about the inflation side of things, the employment and labor market side of things. Now I want to take a step back and just talk about economic indicators, broadly speaking. GDP growth at its surface seems to be showing a slightly slowing economy, cooling down, hitting the brakes just a little bit, grew around 1% in the first quarter. What's your perspective on this?
So that's definitely the headline print. The headline print is that we're a bit slower, about 1%. And according to a lot of economists, they think that the potential growth of the US economy is about 1.8. So we're growing below trend. But I think there's a little bit more nuance to that. So one of the things about the GDP data is that there's a volatile component called inventories. Now, if you take out inventories and you're looking at the actual demand from private consumption and investment, it was actually about 3%. So it was actually better than expected, and there's these inventory shifts that are clouding it. So I think the first quarter GDP is a little bit better than that 1% would suggest. So it seems strange, but we tightened rates to 5%, and the economy doesn't seem to be as sensitive to rates as one would expect. Now, let's take a step back and think about how rates would affect the economy. First, of course, is that they would make asset prices go lower, right? So let's say you'd expect the stock market to sell off, then people have less wealth in their brokerage account, maybe they'll buy less stuff, right? Less demand. But then here we are, Fed funds about 5%, S&P, it's doing fine, it's rebounded significantly. the next thing that we'd expect is that interest rate sensitive sectors like housing do poorly. But again, we have house prices stabilizing and beginning to rise in many parts of the country, home builders at all-time highs. So that doesn't seem to be working the same way as it did the last cycle. And lastly, people often talk about the impact on the dollar. Now, hiking rates is supposed to strengthen the dollar. It's supposed to bring disinflation impacts through import prices, but the dollar's been selling off a lot over the past few months. So we have this weird economy where you've hiked 5 rates, but it doesn't seem to have worked the way that you thought it did. One other thing I note is that vast majorities of people have refinanced their mortgage to about 3% or below. So even though the Fed is hiking, for the typical household, their biggest liability, their biggest debt is their mortgage, and that's locked and completely insulated from Fed hikes. At the same time, they're getting 5% wage gains. So I think the economy might not be as sensitive to the Fed's tools as it used to be.
Yeah, certainly an interesting idea to close out on here, Joseph. And I've got one more question for you before we finish this conversation. You talked in the beginning about the Fed not wanting to surprise markets, about the market expectations for the Fed, given the language that it omitted from its most recent, reports post making this most recent rate hike. Got another meeting from the Fed Open Market Committee in mid-June. What do you think the market is expecting from this meeting?
So the market is now actually thinking the Fed is done hiking rates and that they're going to aggressively cut rates later in the year. Market expectations about 2 to 3 rate cuts later in the year. Now, the Fed is asked frequently about this. So the Fed, in their own projections, are saying that we're going to hold around 5% throughout the year. The market has been testing them and pushing back against that. Now, the Fed is saying that they think inflation is very persistent, and so they're going to hold rates around 5%. Market is thinking that, I don't know what the market is thinking, actually. Some people think it's because they think inflation will be lower than expected, get back to 2% faster. Some people think it's because there are people who think that there's going to be some kind of financial incident. Now, I expect that the Fed is actually really going to stick to their about 5% for the rest of the year. So I think that right now, given the turmoil that we're seeing in the markets, it's a good shot from my perspective at this moment to think that they would just pause and just hold here for the rest of the year. And this could change, but that's what I think so far. The market, though, I want to remind everyone, has been very, very wrong this whole rate cycle. This couple years ago, the market thought the Fed would never be able to hike to 5%. But here we are. So take that with a grain of salt.
Yeah, certainly. Here we are indeed. Well, Joseph, this has been such a wonderful conversation. Really got a ton of insight and clarity on the economy, broadly speaking, the Fed more specifically, and its strategy moving forward. I really appreciate your time today.
My pleasure. Thanks for having me.
Of course. Thank you so much again to our guest, Joseph Wang, CIO at Monetary Macro. And thank you to all of you for listening. I'm Kinsey Grant. This is the Public Podcast, and I will see you next time.